Hi everyone, I'm Shekhar from Factor Lab. I want to start this video in a different way. So far, we have been covering every monthly review in a regular fashion of what are the good stocks, which asset classes are doing well, what is happening with different market caps. But I want to take a pause and focus on the global picture. We are seeing that at a macro level, there is an economic regime shift that is happening, and we want to double down on that. What we are observing right now is that there's a fundamental shift that is taking place in the US 10-year Treasury yields that many of the Indian investors usually miss. And we want to focus on that and how that actually is causing a lot of ripple effects in the other global equity markets. So let's take a step back and see what is the bigger picture and then focus on the Indian equity markets. So let's zoom into the different charts that I'm going to present. So the chart that I'm presenting right now is the US 10-year Treasury yields. As you can see, it was in a downward trend since 1979. This is because there was a US oil embargo that happened back in 1979, in the 1970s, especially when the GCC countries or the Gulf countries had an oil embargo, and because of which the US had to step in and enter into an agreement with the Gulf countries. And also, they have toppled the Iran regime back then. And the agreement with the Gulf countries was that they'll provide the security for their sovereignty, and all the Gulf countries or the OPEC countries which produce oil, they'll purchase all the oil in US dollar denominated currencies, and they'll park these dollars back to the US in treasury bills or bonds. So that loop was successful for a long period of time. So all the countries which were importing oil were purchasing oil in dollars, and the Gulf countries were parking these dollars back to US, and that flow was continuing. And because there was a surplus of the oil that was being produced, there was always a lot of demand for the US bonds, and because of the demand of the US bonds, obviously in a demand-led market, the seller can always have an upper hand if there's a lot of demand, and the seller can charge a lower interest rates for the US bonds. Because of the lower interest rates, the US enjoyed a low inflation regime for the last 60 years, and all the inflation in the world was exported to other countries from US. So the US did not face any difficulties when purchasing the oil because it was always dollar denominated. Now, something radically changed in the year 2022. Now, this downward trend has been broken. Now, we are seeing the US Treasury yields increasing. Now, they are forming a bullish pennant pattern, which is usually a continuation pattern. Now, what has happened in the year 2022? So, in the year 2022, Russia invaded Ukraine, and because of which US has sanctioned Russia, and by sanctioning, they have frozen all their assets, all the Russian assets that were held in US dollar denomination. Now, because of this freezing of the assets, every other sovereign country got spooked that this might as well happen with them in future if they do something against the US interests. So they started to slowly mitigate by buying into gold. They stopped buying the US bonds. Now, once the countries stop buying the US bonds, the demand has slowly decreased. Once the demand has decreased, the US has been forced to increase their yield rates. Now, the yield rates are a consequence of that effect. The trust amongst the US bonds is decreasing, which in turn is causing the US yield rates to spike, and thereby a lot of sovereign countries are now in their sovereign assets they are purchasing gold. This is the bedrock of what we are seeing in the de-dollarization effect. Now let's pause it here. Let me show another chart. This is the 10-year Indian treasury yields, the Indian 10-year government bonds. If you notice, we are also we're in a downward trending channel. But this downward trending channel has been recently broken out. If I zoom in a bit and show the weekly chart, you can see that we have broken out of this downward channel recently. The safe haven, which is gold, if they themselves are increasing the rates, are giving a higher interest rates, if the markets are demanding higher interest rates, then obviously that will have a ripple effect across the government bonds in the country, in the world. And India is no pariah to that. And India also is experiencing the 10-year yields to rise. Now, because of that, the cost of capital is increasing. Now, the government, whenever they borrow, they have to borrow at higher rates and they have to service their interests even at higher rates. And if the government is forced to pay at a higher rates, obviously the capital will flow towards the government bonds because they are the most safe assets available. And if the capital is moving there, then the bond markets will get crowded. The private companies or the private industries will find it difficult to raise money, especially in the debt market, and thereby they also will have to increase their debt servicing. Now, if they have to increase their debt and the cost of borrowing for the private companies increase, it will have two effects. One, the any capex that they intend to do will slow down, firstly, and secondly, it will also reduce their growth prospects. And not just for the corporates, it will also have an impact on the retail households as well, because as the cost of borrowing increases, they will find investing in safe havens to be much better than taking risk appetite in investing in equities or in any other asset classes like real estate, etc. So thereby, what you see is that a rising interest rate usually cools down the growth. It brings down the growth of an economy. It might also bring down the inflation, but the pressing point or the key point to understand is that rising yields will reduce the growth. That is point number one. Let's look at another chart, that is the oil. I'm going to show the Brent crude oil chart on a monthly basis. Now, what you're seeing is a monthly chart of Brent crude oil since 2004 onwards. Now you see that we have now reached a point of around $120 per barrel. This is the usual peak at which the oil touches and again bounces back. Now, what is interesting note here is that this particular rise has been very steep. Just a few months before, the oil were around $60. Now, the earlier oil price increases were because of the demand-led increase, not because of supply-led shocks, be it the 2003 to 2008 or even during the COVID crash. These are all because of the demand either decreasing or increasing that has caused the Brent oil to fluctuate. But now what you're seeing is that the supply is getting disrupted in the Gulf countries. And because of the supply disruption, we are seeing a prolonged increase in price. Right now, it is touching somewhere around $120, $125. It is the all-time peak. And if you also observe the technical pattern, we are also seeing inverted head and shoulders, which is an ominous sign that if at all it breaks this level of $125, then we might see a continued increase in the oil prices. Now, what is the cause of concern when the oil prices increase is that it causes the inflation to rise because oil has a lot of downstream products in terms of other fertilizers, plastics, other chemicals like urea, etc. Now, these are used by many industries or corporates as their raw materials. If the raw materials cost increases, then they have no other option but to increase their selling prices, and thereby they have to pass on the inflation to the end consumer. And if the end consumer is affected by higher prices, then that is what we call as inflation. Now, unfortunately, the inflation in a regular sense can be reduced by increasing the interest rates. But we just saw that the interest rates have already increased. Now the governments or the federal or the RBI banks are in a tough situation. The growth is stalling because of higher interest rates, and also the inflation is increasing because of supply led shocks. So they can't either reduce the interest rates nor increase the interest rates. If they reduce the interest rates, then it will keep on adding to the already higher inflation. If they increase the interest rates, then they're going to kill the growth of the economy even further. So this is a classic a case of stagflation, where the economy is stagnating and the inflation is rising. This is a ominous sign for any economy to be in. Now, we have seen this stagflation during the 1970s, where an entire decade was lost, where there was no growth in the economies, but the inflation continued to happen in the entire decade. Now, let's come back and see how does it affect in different asset classes. Let's first look at our Indian equities, which is Nifty. Right now, Nifty is at a very critical juncture of 22,000, 23,000 levels. Now, if you observe, it has formed a double top pattern. It is testing the levels of 21,700, and this is a very critical level to watch out for. If it breaks this level, then we are in for a further correction. If somehow we are able to retest this, and make a bounce, then we are at least in for a quick short bounce, and maybe in for a sideways kind of a scenario. Whereas, let's take a look at the gold. What is happening with the gold? Now, for gold, we see that it is in a continuous uptrend. And if I look at the daily chart, I see an interesting pattern here, that the gold is taking a support at its 200-day moving average during the previous correction that we saw after a short uh, rally. And if I take the case of 100-day moving average, it has just retested the 100-day moving average again. So this shows that gold is continuing its uptrend. It has not broken down its uptrend. In fact, it has taken a breather, taking support at 200-day EMA, and then again now at 100-day EMA. I can't say the same thing for Nifty. Nifty actually has broken down its 200-day EMA. If you take a look at the Nifty chart, we are way below the 200-day EMA. And in fact, even if we take a very short moving average of 10 EMA, the 10-day EMA is actually acting as a resistance. As and when we touch the 10-day EMA, we are going down. Even now, we are at the 10-day EMA resistance. So it shows clearly that we are in a bear market in terms of the Indian equities are concerned. With respect to gold, gold is in a positive uptrend. Now, this brings me to the bigger picture of how do we allocate in these kind of scenarios. If you were to look back in 1970s, what we have observed is that the gold was the safe haven. Gold was the only bright spot where it had a secular run in the decade of 1970s, when the equities were flat, not just in India but also in the US markets, and the bonds also were not rising, because though on nominal terms, on the nominal terms, the bond yields look higher, but if you actually factor in the inflation, they actually are in the negative territory. The only saving grace is gold. So we are bullish on gold, and that is reflected in our two strategies in small case, both dual momentum as well as an adaptive asset allocation. And apart from that, we have a smaller allocation towards Indian equities. We are not ruling out that the Indian equities have not done well, or they do not have a good bright picture from here onwards. On the contrary, actually, the Indian corporates are on a fantastic footing as of the month of April. I'll show an interesting report that we have just observed. Now I'm going to present the screen of a report which was published by NSE. NSE usually publishes the quarterly reports, and in the quarterly report, what we are seeing is that this is a fundamental analysis of the Indian corporates, the Nifty 500 stocks. Now, this is an interesting chart to observe. This shows the true health of the Indian corporates. They have plotted quarter on quarter PAT margins of the Nifty 500 companies from June 2015 onwards till now, more than 11 years. We see the trend to be an upward sloping, meaning the Indian corporates have kept on improving their PAT margins year on year, quarter on quarter from 2015 till now. Back then, the Indian corporates were having a profit after tax margins somewhere close to 4.5%. And during the ILFS crisis, they even went into the negative territory. During COVID, also, we were in the negative territory. But after COVID, we had a remarkable shift in the profit after tax. We stayed at the elevated levels of 8%. During the Russia-Ukraine crisis, we again fell down to 4%. Again, we quickly plunged up. We are inching towards 8 and 10% in the profit after tax margin. If you see the corporates of India across the top 500 companies, they are doing a fantastic job, a phenomenal job of giving greater than expected profit after tax returns. They are second best as compared to the US markets. I've also alluded to this fact in my previous videos that in terms of the operating margins, PAT margins, we are one of the best. The problem is in the valuations and in the growth. The growth has been tepid. On some quarters, we're doing well. There are some pockets of sectors which are doing well, and then the consumer sector is lagging. The IT sector is lagging. Of late, the private banks were also lagging. Only bright spots are the government infra spend, which is resulting in the public sector enterprises or the infra sector to picking up. The PSU banks are doing well, but the real estate is not doing well. The Indian growth story in terms of consumption is also not doing well, especially in the FMCG. So we are seeing a mixed bag in terms of growth, as well as in terms of not just the growth, but also in terms of exports because of the AI threat. But broadly, the margins are good, and the valuations are also not that great. Because of the recent correction, we are seeing a good uh, reduction in the valuation multiples. But the thing to note in picture is that can we sustain these elevated level of profit margins? If you're able to sustain these elevated levels of profit margins, then the Indian equities become attractive for a long-term buy. So to summarize, we see that the allocation towards gold needs to be increased. It is not just a hedge anymore, it is a co-anchor in one's portfolio. The equity markets in the Indian context, the valuations were high. Now they've come down to a decent level. But these valuations can only sustain if the profit margins as well as the growth can continue. But as we've also pointed earlier, that the oil shock is in for here to stay, and this might have a sustained impact on the corporate earnings. So we need to look at the how does it impact the corporate earnings. There are certain sectors which are shock proof or resistant to the oil prices. So identifying these sectors and stocks is important. Now that's the key takeaway that we see. And in terms of the other sectors or other spots where we are seeing a good uptrend to be continue is in the other emerging markets of Asia. We see the Taiwan index, or even for that matter, the Korean markets to be in a structurally bull trend. I mean, these are good places to invest. And in fact, even the Japanese markets or the Chinese markets are also in a decently uptrend compared to the Indian markets. So though they also provide a good diversification benefits in times like these, where you see that the Indian current markets are having a tough time, especially in the last 2 or 3 months. So that is it from this month video. Looking forward to the next month's video. Have a nice day. Thanks a lot. Bye.